Talk about four fundamental cores of accounting. Okay, so let's go one by one. But before that, let's understand why accounting is very important. Accounting is the language of business. So it's a system of recording, summarizing, and interpreting the financial transactions. So understanding accounting is crucial for everyone involved in business, whether you are an entrepreneur, investor, or an employee. So let's learn about the core fundamental concepts of accounting, including the accrual accounting, financial statements, and cash flow. So the four fundamental core of accounting is accrual accounting. Okay, so let's move it here. Okay, accrual accounting. Then we have income statement. And then you have a balance sheet, and finally also you have a cash flow statement. So this is a fundamental core of accounting that we are going to talk about in this lesson. So accrual accounting, what is it? Okay, so let me just open this one a second. Okay, so these are the four fundamental core of accounting. So the first one we're going to talk about is accrual accounting. So accrual accounting, what is it? It's records the financial events when they are going to happen. Okay, so the important thing is accurate accounting. So like whenever the recording of financial statements happens when actually really it happens. Okay, not just when the cash changes hand. I will give you a simple example. For example, if you provide a service in December but you get paid in January, so accrual accountants recognizes the revenue in December. So it's about matching revenues to the period they were earned, and expenses earned, and the expenses to the period they were incurred. So there are two important concepts here that you have to understand. That is, one is earned, and another one is called incurred. So earned, it's also like something, it's like a revenue. So the key understand the thing is that you have to understand is the revenue is recognized when it is earned. Okay, so that is the when you provide the service, provide service, right? When you deliver the goods, even if the payment is later. Okay, so this is revenue. And incurred are the expenses. Says okay, so like for example, resources used up. Okay, so it can be something like that. Okay, even if the payment is later. So why accrual accounting is important? It's because it provides more accurate picture of the company's financial performance over the period. So it gives you a truer picture of company's financial performance during the specific period, and also it helps managers to and investors make better decision based on the most complete financial picture. So it is a contrast it has a contrast with cash accounting. So cash accounting only records transactions when cash is received or paid. It's simple but less accurate. Okay, so service provided in December, payment received in January, for example. So revenue is recorded in December, that is accurate, not January, because in cash accounting like the revenue is recorded in January, not December, when actually it happened. Okay, so this way accrual account is more accurate. It gives you a true picture of when actually the specific transactions happened. Okay, so now let's also understand about some. Okay, there is a important concept that's called double entry system, which is called okay, double entry system, which is called debit, and then you have a credit. Okay, So let's minimize it. Okay, so you have a debit and credit. It's too small, so I'm gonna sorry okay, let's improve this. Okay, so debit and credit. So debit and credit is a part of a double entry system. So every transaction affects at least two accounts. Debits and credits are tools used to record these changes. So debit, what happens is actually it increases the asset accounts, like for example cash accounts, cash and accounts receivable. It also increase the expenses account, like example rent, salaries. Okay, it decrease the liability account. So for example, we have a account payable and loans. It also decrease the equity accounts. So example is retained earnings, or it's also called dividends. Okay, the profit is being divided. Okay, like the profit is calculated after reducing all the expenses, and then this is called retained earnings. Okay, so this is all about the this is about debit. So let's learn about credit. Is you have a increased increase liability accounts, then you have an increase in equity accounts, and then you have an increase in revenue new accounts. Example, you have a sales. So then you have a decrease in assets asset accounts, and you have a decrease in expenses account. Okay, so you see the difference between debit and credit. Okay, so the basic understanding here you have to understand is in debit you have two important things, that is you have assets. Okay, whereas in credit you have a liability and you have a equity. So this must be equal. Okay, so there is a fundamental accounting equation that says that debit is equals to, like, assets is equals to liabilities plus equity. Okay, liability plus equity. So you have to understand this concept. So for every transaction the total debit must equals to total credit. So you see, debit assets, there is a formula that you have to understand. Assets equals to liability plus equity. Okay, so here yeah, this is how it's happening here. Okay, so now let's go to the another important concept. Okay, which is the second concept, that is income statement. Okay, income statement. Okay, so what is the income statement? Also called as a profit and loss statement. Okay, profit and loss statement. So it shows the company's financial performance over a specific period. Company's financial performance. Okay, so let me write down the key concepts here. Money financial performance expense over a specific period. Okay, it can be a quarterly, like 1/4 of a year, or 1 year. So it's like a report card for the business. So what it shows, so how much money the company made, revenue, and how much cost it made, it makes that money, how much it costs to make that money. So it has also costs and expenses, and how much profit is generated. So these three key concepts is being like it provides these three key concepts, like profit and loss statement. So revenue, cost and expenses, and the profit, how much profit is generated. So the key competence, as I told you, is the revenue. So we're gonna check it one by one. Revenue. So in the revenue, the total amount of money a company earns from its primary activities. For example, retail store revenue is the total sales from the product goal. Total sales from product sold. Okay, so and now let's talk about costs. Cost of goods sold. Okay, COGS. It's the direct cost of producing the goods sold by a company. It's like a direct cost. Then like for example, you have a direct cost, like example, you have a raw materials for making a product, or labor, salary. Okay, so then you have also operating expenses, like cost incurred in running the business, cost incurred for running the business. Okay, not directly tied to the production, like for example, rent, utilities, salaries. Okay, staff, marketing. Okay, then you have a EBITDA. Okay, so this is also called EBITDA. Okay, earnings before interest, taxes, depreciation and amortization. Okay, it's like a measurement of company's operating profitability. Okay, before non-cash expenses and depreciation and amortization and financial cost, or interest and taxes. Okay, so it's a measure of company's operating profit. Okay, then which is actually calculated by formula is EBITDA equals to revenue minus cost of goods cost of goods supplied. Okay, products of cost of goods sold, sorry, and then operating expenses. This is equals to EBITDA. Okay, it's a good indicator of company's core operational performance. And then you have earning per share, EPS, or earning per sales, which is like a portion of company's profit allocated to each outstanding share of a company's stock. So you can like the key concept is like it's a key metrics for investor to access a company's profitability on a per share basis. So then also you have growth rates and margins. So you have revenue growth revenue growth rate. Okay, so this is the and margins. So let's talk about the growth rate. The percentage revenue growth rate is the percentage change in the revenue from one period to the next. Okay, so it's also it's like a simple growth, like growth rate measures the percentage change in the specific metric, change in a specific metric over a period of time. Okay, so you have a simple growth rate, that is a present value minus the past value. Simple growth rate. Okay, simple growth rate equals to present value. Okay, so let's see it. So present value minus the past value is divided by the past value into 100%. Okay, so this will give you the rate. Okay, simple growth rate. Then you have a compound annual growth rate. Compound annual growth rate, which the formula of this one is ending value by ending value power 1 by number of years, okay, minus 1. So this is this calculates the compound annual growth rate. Compound annual growth rate calculates the average annual growth rate over multiple years, assuming profits were reinvested at the end of each year. Okay, so finally, like also you have the margins. So margins represents the profitability of the business or product, usually expressed as a percentage of revenue. So here for margins, we have a gross profit margin. It is calculated using the revenue minus cost of goods sold, divided by revenue into 100, gross profit margin. Then you have a this margin shows the percent of revenue remaining after deducting the direct cost of producing and selling goods or services. Then you have a operating profit margin. Okay, this is being calculated by using operating income divide by the revenue, and you just multiply it by 100. So operating income is equals to the EBITDA. Okay, this operating income, you can calculate it by this formula. Okay, then the net profit margin is calculated using net income by revenue, net income divided by revenue multiplied by the 100. So this margin, this net profit margin represents the percentage of revenue remaining as profit after all expenses including taxes and interest has been paid. So all these formula are very essential tool for analyzing the financial performance and tracking progress over a time. So okay, let me summarize the key points. Okay, so what is the revenue? Is like if the money is in, like money is inside you, only like you receive the money, that means it's a revenue. Then you have a cost of goods sold, which is like direct cost of making what you sell. Okay, direct cost of making what you sell. Then you have operating expenses, which is also cost of running your business. Okay, then you have EBITDA. This is a profitability of the core business. Profitability of the core business. Okay, then you have margins, which is like how much profit is left at different stages. Okay, so then you have a growth rate, which is how fast the revenue is growing. Then you have a finally the EPS, which is also called your earning per sale, which is like profit per sale. Sorry, it's growing. EPS, earning per sale, is like a profit per sale. Here. So income statements answers this question, like how much money did the company make, how much did it cost to make the money, and how profitable is the company. Okay, how fast is the company growing, how much profit is allocated in its share. So profit per share. Okay, so this is all about the second fundamental core, that is income statement or profit and loss statement. Okay, so we're gonna now move on to the third fundamental core, that is called balance sheet. Okay, so what is the balance sheet? It's a core, it's a snapshot of company's financial position. Company's position at a specific point of time. Okay, so by analyzing the balance sheet, investor, creditors, and management can access a company's financial health, liquidity, solvency, and overall financial position. So it's a vital financial statement that provides a clear picture of a company's. So you have a balance sheet, that you have equity, this three core concept, equity. Okay, so the owner's stake, the assets, like what it owns, and then the liabilities. Okay, what it owes. As I do, there is a accounting core fundamental formula, that assets equals to liability plus equity, right? So you need to understand this formula. So the key components are, as I told you, is that the first thing is the, okay, let me write the formula. Assets equals to, okay, what is assets? First thing is the assets. Okay, assets. Okay, it represents the company's own, what a company owes or controls, and it has a economic value. Okay, there are resources that the company expects to provide future income benefits. They are typically listed in order of liquidity, how easily they can be converted to cash. So current assets, so these are assets that are expected to, okay, you have two things, like we have current assets, which is like assets which are expected to be converted to cash, sold, or consumed within 1 year or the normal operating cycle of the business. Expected to be converted to cash, sold or consumed in within a year or normal operating cycle. Ting cycle. Okay, then you have a like, okay, so these current assets can have okay, then you these current assets can have a cash and cash equivalent. So the most liquid assets, including physical cash, bank accounts, short-term investment that can be easily converted to cash, like money market funds, treasury bills. Example, money market funds, treasury bills. So these are the example of a cash and cash equivalents. So then you have a short-term investment. Okay, this that can be expected to convert to cash within a year. Then you have a account receivable, that is the money that you owned, money owed to company by customers that for goods or services already delivered. Okay, then you have also like inventory. Okay, you have inventory, like a good held for sale to customers or raw materials used in the production. Then you have a prepaid expenses, like expenses paid in advance, such as rent or insurance that will be used up in the future. Then you have other current assets, like any other currency that is can be converted to cash within a year. Okay, so this is all the current assets. Okay, so now let's talk about non-current assets. Okay, so this is assets can be have two. Okay, so you have a can have a current assets, and you can have a non-current assets. Okay, so okay, you can have current assets and non-current assets. Okay, so non-current assets are long-term assets. Okay, so these assets are not expected to be converted to cash, sold or consumed within 1 year. So these are long-term assets. Okay, so you have a property, plant and equipment, like PP&E, property, plant and equipment, PP&E. You have long-term investment. You have intangible assets, and you have other non-current assets. So intangible assets are assets that lack physical substance but have economic value, such as patents, trademarks. Okay, patents, copyrights, trademarks, goodwill. Okay, so that's it. Investment, long-term investment are investment that our company intend to hold for more than 1 year. Okay, so this is pretty simple. Okay, so this is about all about the assets. Okay, let's now talk about the liabilities. So it represents the company, what the company owes to other, what company owes to other. For example, bank loans. Okay, and there are claims that against the company's assets. Okay, so you can have also two liabilities, like liabilities divided into two. You have current liabilities, which is these are the obligations that are expected to be paid within 1 year. You can say paid within 1 year. Okay, or the normal operating cycle of the business. So you have account payable, for example, like money owed to suppliers for goods or services purchased on credit, or you have a short-term debt, or you have accrued expenses. You have accrued expenses. Short-term debt are like loans or borrowings that are due within 1 year. So accrued expenses are the expenses that can be incurred but not yet paid, such as wages payable, tax payable. You have unearned revenues, so money received from goods, customers from the goods or service that had not yet been delivered. Okay, so unearned revenue is like you have already received the money is received but goods not yet delivered. Okay, so this is unearned revenue. So you can have also current portion of long-term debt. Okay, so the portion of a long-term debt that is due within 1 year. Okay, so other current liabilities also, like other obligations that you need to pay within 1 year. Okay, so what about the non-current liabilities? So this is the second kind of liabilities, that is non-current liabilities. So which you are obliged to be paid or expected to be paid, not within 1 year but more than 1 year. So maybe it can be 10 years, 5 years, 2 years. Okay, more than 10 years. So it's like a long-term debt. Okay, so it's also like a deferred tax liabilities, tax that are owed but not yet payable. Then you have a pension liabilities, like obligations to provide pension benefits to the employees. And then you have any other non-current liabilities or obligations that are not expected to be paid within 1 year. Others. Okay, so this is all about the liabilities. So now let's talk about another third component, as we told you. So in this assets, liabilities and equity, we have we talked about assets, we talked about the liabilities. Now let's talk about the equity. Okay, so equity represents the owner's stake in a company. Okay, so it's the residual interest in the assets after deducting the liabilities. Okay, so you have equity is also, you have a contributed capital, the amount of money the owners have invested in the company. Owners that have is money invested by owners. Okay, you have a contributed capital. Then like a common stock, okay, like stock, you have a preferred stock or type of stock that may have certain preferences over common stock. Okay, additional paid in capital, the amount of money received from investors over the par value of the stock. Then you have so after that you have also retained earnings. Okay, this is the accumulated profits of the company that has not been distributed, profits not yet distributed. Okay, retained profit. Then you have a treasury stock, which is like a shares of company's own stock that it has repurchased, own stock that it has repurchased. Okay, stock repurchased. Then you have other comprehensive income, so like gains or losses that are not included in net income, such as unrealized gains or losses. On certain investment. So this is all about the balance sheet. Okay, so and now let's move on the final fundamental core concept, that is the cash flow statement, CFS, or let's say cash flow statement, or CFS. So this cash flow statement, it tracks the actual cash moving into and out of the company. Tracks the actual cash moving in and out of the company. Moving in and out of the company over a period. Okay, so it's like the actual cash statement. Okay, so like the actual cash that is moving in and out of the company. It's different from profit, which is an accounting concept. So cash flow statement shows where the cash comes in, where the cash comes in from and where it goes. So it's like cash in, cash out, cash in and cash out of the company over the period of time. So there are three main sections of the cash flow statement. Is like cash flow from operation, cash flow from operation, cash flow from operations, or you can also say cash CFO from operations. So it's like a cash generator or used by the company's core business activities like selling goods or services. Why it matters? Because it shows the business of shows if the business is fundamentally profitable in terms of cash. So positive CFO is good, and negative CFO means red flag. Negative CFO, red flag. Okay, so it's not good for the company. So positive CFO means good for the company. Then you have also key terms like key items like cash from customers, cash to suppliers, salaries, rent, tax, interest. So you can say salaries, okay, rent, taxes, interest, cash from customers, cash to sub, and you can calculate it from direct or indirect method. Okay, so these are the key terms. Okay, it's okay. So now let's talk about the another section of cash flow statement. Is like cash flow from investing, or you can also say CFI. What is it? It's a cash flow that is related to long-term assets. Cash flow to long-term asset. It's like property, for example, property, equipment, investments. Okay, why it matters? Because it shows if the company is investing in growth. Okay, like buying assets or selling off assets. So positive CFI means selling assets, company is selling the assets. Okay, so if you have a positive CFI, you need to understand that the company is selling assets. So so the key items are like buying, selling equipments, buying, selling investments, acquisitions. So it's all related with the cash flow from investing. So let's move out further with the another concept. Is like cash flow from financing, or you can also see FF. So cash flow related to how long the company is funded. That's what is it? It is like cash flow that is related to how the company is funded. Okay, how it is financed. Okay, so like what is the debt, what is the equity, what are the dividends. So it's all comes in the cash flow from financing. So why it matters? Because it shows how company is raising capital, how company is raising the capital, or returning money to investors. Money to investors. So it's there are two things here: how company is running, raising its capital, and how the company is returning money to its investors, okay, who are investing to this company. So positive CFF, positive cash flow from financing, CFF, means it's raising capital, and negative CFF means paying down debt or returning money. Means paying debt or returning money. So the key items are borrowing money, repaying loans, issue stocks, buying back stock, paying dividends. Okay, so this is all comes in the cash flow from financing. So finally, the key takeaway is cash is the king. So in the cash flow statement, the cash is the most important thing. So cash flow statement focus on the cash, not just profit. A company can be profitable but still run out of cash. Okay, so cash flow from operations is crucial because the healthy company usually has a positive CFO. Okay, so meaning it's a core business generating cash. Its core business is generates the cash. So cash flow from investment and cash flow from financing tells a story. Okay, so this sections how shows how the company is growing, investing, and managing its financial. So you need to look at the trend. So don't just look at one period, look at the trend over the time to see if the company cash flow is improving or declining. So you can there is a cash flow from operation can be calculated using the direct and indirect method. So if in essence the cash flow statement answers these questions, like if the company's core business is generating the cash, is the company investing in its future. So it's going to answer this kind of questions. So how is the company funding its operation and growth, so where the cash is coming in and where is it going. Okay, so it's all about that comes in cash flow statement. So this is very important. So I think you guys have enjoyed this tutorial, and try to understand this. It's very cruel and fundamental for understanding the accounting. It's a core fundamental concepts for accounting, and that's it. Thank you.